And we are live. Hello, everyone. Thanks for joining us for another episode of Stocks from Scratch. If you're new to this series, Brian Stoffel and I take a stock that we don't know well and we research it live in front of you. We're going to be digging through SEC filings. We're going to be looking at conference calls. We're going to be digging through press releases, all in an effort to figure out whether or not we think this stock is investable or not. Thanks to stockcard.io for sponsoring today's video, which is all about Affirm, ticker symbol AFRM. Brian, what is your current working knowledge of Affirm?
So, what I know about Affirm is it's part of the buy now, pay later trend, which I have mixed feelings about. I think I need to learn more about it to see whether or not this is a healthy thing for society. But I learned about it through a friend of ours, Motley Fool analyst, and I really started paying attention when Amazon announced that it was going to be partnering with Affirm for buy now, pay later payments. So that's pretty much my working knowledge. I've never used it myself.
I also haven't used it before. I have, I think, seen it a couple of times on e-commerce sites when it's like, would you like to pay with Affirm? Like you, I'm kind of mixed about whether buy now, pay later is a net good or a net bad thing, but it's a mega trend in fintech that we need to pay attention to. My initial thought about Affirm was very similar to yours. Well, my initial thought was, what's the moat here? Like,
Right.
you're just chopping up payments. And I know that companies like PayPal, Afterpay, and many more are doing the same thing. So hopefully we can really dig into that section to really make me comfortable. I
And
do
really,
know that this
I was just going
comfortable.
to say too, like, what's the risk? Like, if people don't pay back, what's the level of risk there?
Who's taking that on?
Right.
Yeah, yeah. And I do know that this company was co-founded by Max Levchin. I'm pretty sure I pronounced his name, who is a co-founder of PayPal.
Oh,
So
okay.
someone who deeply understands and knows the space. But with that, let's get researching.
All right. So
Uh,
does that mean he's part of the mafia?
yes,
Oh,
PayPal
all right.
Mafia for
The
sure.
PayPal mafia,
So you
to be
got
clear.
that going for it. All right. So how did we come to choose Affirm? This was all voted on by our YouTube channel members. It was the number one choice. Special shout out to our channel members. Thank you so much for joining. We really appreciate it. 97 and counting as of the time of this recording. If that interests you and you want to vote on these in the future, please just click the join button. So thank you to everybody for joining the channel. It really means a lot. All right, so let's start with Affirm, ticker symbol AFRM on Stock Card, who is the sponsor of today's video. So this is a $146 stock.
Looks like it came. Oh no, that was just a. Oh no, it came public in January. Okay.
Yeah, it's relatively new to the markets. So it looks like it
was
kind of
down
nothing and then it's up. So I'm guessing it's a market beater since it came public.
probably, yeah.
Yeah, but it didn't have a great debut, and then I'm guessing this was the Amazon news that
Yeah,
all of a
that's what I
sudden
was
made
thinking
things.
too.
Affirm Holdings offers a platform for digital and mobile-first commerce. It comprises a point-of-sale payment solution for consumers, merchant commerce solutions, and a consumer-focused app. All right, so the consumer-focused app is just a part of it.
Merchant commerce solutions. That sounds familiar to
Like
the kind of
Shopify,
to the merchant solutions that Shopify has.
the firm generates its revenue from merchant networks through virtual card network, among others. Geographically, it generates a major share of its revenue from the United States. So, yep, it IPO'd earlier this year, a $40 billion
Whew,
business.
that's way bigger than I thought.
Yeah, pretty big. Let's see how it's done so far. So, sales growth, I bet it's growing fast, 70%. Yep, so growing very, very quickly. Its 3-year growth rate is not available on Stock Card, but current fiscal year about 40%. Is it profitable? Not on an EPS basis. Not on an EPS basis. Its gross margin is about 60%. Okay. Cash availability. It's got a good quick ratio. Its free cash flow is negative. So
Negative
negative
213.
negative 213 million. Obviously, with no positive earnings, all of those return on invested capital metrics are negative. And year to date, it's up 50%. So it's beaten the market since coming public.
One thing I'll say with that negative free cash flow is usually I just take free cash flow, however it is. However, with a company like this, it's important to see why it's negative free cash flow, because they might be taking on some of the risk. And in doing that, their free cash flow would actually be much higher. It's important to look at the aspects of where they're losing money on this, because it might not tell the whole story.
Sure, all those details certainly matter. Okay, I know that you can't read this. You're going to have a hard time. So it says Affirm's mission is to deliver honest financial products that improve lives.
Hey, that's great.
That's a company that understands mission statements.
Yes.
To deliver honest financial products that improve lives. The improve lives part, I'm not like super like way hooray optimistic. Like that's not like super inspirational, but it's definitely simple. It's definitely optionable.
Yeah.
Good job on there. With that in mind, we are building the next generation platform for digital and mobile first commerce, making it easier for consumers to spend responsibly,
I'll see.
spend
That's one of my
responsible,
things. Yep.
and with confidence. Easier for merchants to convert sales and grow, and easier for commerce to thrive. And then there's an 11-minute video on it. Okay. So we will go to the most recent news. So there's some news. I know in there is going to be, Amazon. The Amazon news is a big deal.
And that was
Big deal.
August 27th. Okay.
Yeah, Amazon plus Affirm. Like that's a question that I have. Like, why can't Amazon do this themselves? Is it that hard? I don't know. Okay, so let's go to. We'll open up the management team. We'll go to SEC filings. So we are looking for the. Let's see. They came public earlier this year, so they probably don't have an annual report.
No, they do.
Oh, they
their
do.
fiscal year ended. Yeah.
They do. Okay, their annual report is for September, so we'll open that up, and then we'll see if they have a proxy. Do they have a proxy statement? No filings there.
So there you'll need the 424B4.
Yep, 424. I wonder if I can. Nope, it's not gonna be in a group. How do they do it under registration statements?
There it is.
So the registration, so the 424B4, we'll need that for ownership.
Do you want to save our Twitter research for later?
Yes.
Okay.
I also found a great Twitter thread that we're going to read through from Francis Analyst to tell us more about the company. All right, so this is the 424B4. This is the post-IPO prospectus on Affirm. So it's going to tell us all about the filing. So they priced, for example, at 49.
And what are they at now? I don't remember.
149.
Okay, they've done
awful job, bankers, of getting this company to capital. And left
although
$1 billion.
They got a bunch compared to where they were 6 months later.
Sure. Okay, so total proceeds to us, they've raised $1.1 billion at $49 per share. Okay. Building honest financial products that improve lives.
Consistency.
So far, so good, Affirm. Our vision to be as
They
ubiquitous,
understand the difference,
secure, and convenient as legacy networks, yet far more transparent, honest, and both consumer and merchant-centric. Okay? A letter from Max Levchin, founder and CEO. Cards, the modern way to pay for goods and services, appeared just over 7 decades ago. Since then, the user interface has consistently improved, but the products themselves have failed to keep up with the evolving world. In fact, one could argue that cards have devolved, becoming corrupted. The barely readable fine print makes one thing clear to consumers. You'll never know exactly what your purchases will really cost you.
I like, especially the credit card debt that people get into.
Yeah, it's a big problem.
It's a huge problem.
With most of the payment industry driving profits from late fees, overdraft charges, and gimmicks like deferred interest, it's not hard to agree that there has to be a better way. It's time to evolve payments.
I'm on board with that.
We founded Affirm in 2012 to lead this change and to build the first payment platform with a moral backbone and consumer-first mindset. Our vision is to be as ubiquitous, secure, and convenient as legacy networks, yet far more transparent and honest and both consumer and merchant-centric. We believe that consumers deserve absolute, immutable clarity in what they will pay and when it's due. We believe that the morality of each financial project offered to our consumers is a key consideration and is an essential part of the Affirm brand. We put what is good for our consumers first and will never benefit from their mistakes or misfortune. So, if this is all true, right now in my mind, I'm thinking they might have counter positioning.
Absolutely. And let me just point out, one of the most important things about counter positioning is that you've got to start and tell everybody that this is what you're going to do, because I have no doubt that this is much less profitable than a credit card company. But
It
it
could be.
doesn't matter. It's fine as long as that's what you're starting with and that's what your investors expect. Then there's nothing stopping you from taking this approach. So yes, I think counter positioning might be one of them.
Do you want to explain what we mean by counter positioning?
Sure. It means that your Visas or MasterCards or Discover cards, they do make a lot of their money on the things that you're talking about, that the founder is talking about, like late fees. And if they were to adopt a firm's take where they're not trying to make as much money off of late fees, I mean, the percentages on some of those are incredibly high. They would have to give up a ton of revenue. Now, if they were willing to bite the bullet for, say, 10 years, then they could probably squash Affirm. But good luck finding a community of investors who are going to let you do that. Private equity is probably going to come in, buy out enough shares to vote to change it and squeeze the money out of it and kill the credit card company,
Yeah.
but make a lot of money in the process. So that's why what Affirm is doing is so powerful, potentially, because Visa and MasterCard can't do this. Now, just to put this in perspective, I, in my life, have only really, I think, witnessed one company counterposition itself, and that would be Netflix.
Mm-hmm.
When they decided to switch from DVDs to streaming, they realized that they had to give up the DVD business, and they almost lost it. Like, Reed Hastings came out and said, we screwed this up the way that we did it, but it's clear that it was the right thing to do. And they had to go through pain for 3 or 4 years, and investors had to lose crazy amounts of money.
Peak to trough, it was 85%.
There you go. However, since then to where we are now, Netflix was able to do that. I really doubt MasterCard or Visa would be able to do that.
So one counterpoint there, MasterCard and Visa, they don't make fees off of that. They're just toll booths. But the real competitor here would be Discover, and they would be American Express. They make money off of the charge, and it would be the companies that partner, banks that partner with MasterCard and Visa that make those kind of fees. So
Got it.
Visa and MasterCard are just the rails for processing transactions. So I don't view this, unless I'm misunderstanding it, as a threat to them. I view this as a threat to American Express, Discover,
and the banks,
and the banks.
Okay. Thank you. I don't know as much about this.
Just
this
from
industry.
that's
just
from that perspective. Also, counterpositioning only works against those companies. It doesn't work against rivals in your industry.
Exactly.
Right. So like Afterpay, I know, which was just bought out by Square. They're doing this. So you don't have counterpositioning versus them.
Right.
Yeah. So just worth throwing that out there. We believe that consumers deserve absolute immutable clarity in what they will pay and when it's due. Yep, all that's good. We believe that merchants should expect significantly more value from the payment brands they accept in the form of more sales, more new consumers, and a much better understanding of the buyers they serve. We believe merchants should expect both their bottom line and their brand to benefit from accepting Affirm. We think it will take no less than a full reinvention of how payment work, and that significant parts of today's infrastructure will ultimately have to be fundamentally modified or replaced to take full advantage of these ideas. That's counterpositioning. That will take time, require radical innovation, long-term investment, and focus.
Only upstarts can do things like this.
Yep. So here's a whole bunch more. We're growing. Thank you, Max. Okay. Building the next generation platform for digital and mobile first. 6 million consumers, and this is not the most recent file. So this is when they filed to go public, or at least afterwards. 6.2 million consumers, 6,500 merchants, 64% from repeat consumers. GMV, gross merchandising volume, 10.7 billion. dollar-based merchant retention rate, 100% plus.
I'd need to know what exactly that meant.
That's like their dollar-based net revenue retention rate. So it's
Okay.
net. So 100%. Yeah, you can't compare this to a SaaS company. It's slightly different, right? But
Yeah.
they're maintaining and growing their on a merchant basis.
I wish I had a more accurate number than 100% plus.
Yes. NPS, Net Promoter Score, 78. That is a damn good number.
Yep.
Very, very good number right there. GMV is growing. In fiscal 2020, it grew 77%. And before that, it was also growing very strongly. Okay. Prospectus, mission, deliver honest financial product that improve lives.
Way to go!
3 for 3. 3 for 3. Okay. We are building the next generation platform. Can you read that, Brian?
I can.
I'll try and go in as close as I can. For the next generation platform, okay. The very best engineering and a mission-driven approach, we can reinvent the payment experience.
One quick thing, Brian, just because we got a question and we hate when other people do this. GMV stands for gross merchandise volume. In other words, the amount of transactions Affirm was able to approve, the dollar value of all those transactions.
All of the money that flowed through Affirm's network. That's not revenue. That's like going from consumers to merchants. From that, I'm guessing it takes a cut.
Yes,
like a small,
probably a very small cut.
Yeah, probably a few percent. So like that's just a total volume of transactions flowing through the network.
Yep.
It's very common on Etsy and Shopify to report gross merchandising volume. Fiverr. Legacy payment options, archaic systems, and traditional risk and credit underwriting models can be harmful, deceptive, and restrictive. Yep. We address these problems. It's 3 solutions: a point of sale payment solution for consumers, merchant commerce solutions, and a consumer-focused app.
I'd love to know what those merchant commerce solutions are. I'm guessing.
I'm hoping we're going to find out.
It would be like data on their customers,
but and probably and a way for them to attract customers.
Right.
Our point of sale solution allows consumers to pay for purchases in fixed amounts without deferred interest, hidden fees, or penalties. We empowers consumers to pay over time rather than paying for a product entirely upfront. This increases consumers' purchasing power and gives them more control and flexibility. Our platform facilitates both true 0% APR options and interest-bearing loans. With 0% APR, consumers pay 0 interest and 0 additional costs. On the interest-bearing loans we charge simple interest,
which means
not compound interest.
Right. Which means that they'll just, if it's 1%, it'll just be 1% of the 100 going forward.
Continually. It doesn't compound on itself. That's simple interest. Yep. Simple interest is better when you're paying, worse when you're collecting.
And so they're choosing the worse because they think that's the morally correct thing to do.
Which means consumers pay fixed amount of interest and that they agree to upfront, and the interest never compounds. We believe in treating people fairly, which is why consumers never pay more than what they agreed to at checkout, even if they miss a payment. Yeah, who's taking that risk? Paying with Affirm not only protects consumers from hidden fees, but allows them to avoid traps such as deferred interest. We offer merchants highly effective commerce solutions that enhance demand generation and consumer acquisition. Our solutions empower merchants to more effectively promote and sell their products, optimize their customer acquisition strategies, and drive incremental sales. Our payment flexible solutions allow merchants to solve affordability for their customers, providing a revenue accelerator while avoiding discounts and other expensive marketing and promotion channels. Yeah,
that makes sense.
If you're selling something, having this kind of payment option is only going to increase your conversion rate.
Yep.
We also provide valuable product level data and insights, information that merchants cannot easily get elsewhere, to better inform their marketing strategies. Our approach allows us to add value through the full customer lifecycle, from acquisition to conversion to repeat transactions. Okay. Our consumer-focused app unlocks a full suite of Affirm products for a delightful end-to-end consumer experience. Consumers can use our app to manage payments, open a high-yield savings account, and access a personalized marketplace. Our marketplace serves a discovery platform which allows consumers to find products and make purchases from partner merchants.
Now that is brilliant.
In addition, our app allows merchants to provide tailored offers based on consumers' spending patterns, shopping habits, and purchasing intent. So it's not just a tool for chopping up payments, it's also a platform that consumers can go to.
Yeah, it's like Amazon in so much as you're saying if you are an Affirm customer, we've got enough data to know what makes sense for you. Here are your options.
Our business benefits from broader trends. Gen Z and millennials, that's those born between 81 and 2012, comprise the largest portion of the US population, and they spend 2.5 trillion. Most importantly, we believe these consumers are also increasingly looking to solutions like buy now, pay later as superior, more transparent payment options to match the demand for technology and mobile first. Yeah, I can see this being appealing. Would you're worried about consumers or people taking advantage of this, as am I. Would you rather have them do this or pay with a credit card?
Oh, I'd much rather have them do this. What I'm most interested in, I remember seeing a tweet somewhere at some point in time about how since buy now, pay later had just started, we were starting to see what the default rates were on them. But here's the thing. One, I don't remember that. It was just something I saw. I don't know what the source is. But two, just because that's a trend in the overall niche doesn't mean that that's happening with Affirm.
Right. Most importantly, we believe our innovative approach based on trust and our steadfast commitment to our core values uniquely positions us to define the future of commerce and payments. Our company is predicated on the process of simplicity, transparency, and putting people first. Our distinctive culture sets us apart, as our principles are not just words on our wall, but are we affirmers run our business and design our products. We have charged zero in late fees. We never profit from mistakes. Okay. We believe that technology are collectively our key competitive advantage. Okay, let's read that again. We believe that technology, underwriting, and risk management, managing risk are collectively our key competitive advantages. Our proprietary technology platform and data give us a unique advantage in understanding consumers and merchants, as well as pricing risk, which we can almost always accomplish within seconds at checkout. Our approach to risk management is core to our business model and has been proven to lead to low fraud rates, higher approval rates compared to traditional credit underwriting models, and low credit losses.
That little part right there reminds me of a company we covered when we did this for the Motley Fool. Do you know
Riskified?
Riskified?
Yeah.
Absolutely.
Yeah, for sure. I'm just trying to think how many companies are claiming that they can do this.
This is
It's growing.
understanding the data advantage is the key.
Yes. Or just watching the numbers to be like, great, prove it.
Yes,
Yep.
that's true.
Our models have been built on more than 1 billion data points, including data from over 75 million loans, over 6 years of repayments. They're continually getting better and more precise with each transaction. Do you buy that? The more data they have, the better
Yeah,
they are getting? Okay.
I buy that.
Okay.
I don't know if it's notably better than someone else's, but I buy that it's getting better.
As of September 30th, we have 6.2 million consumers. So that
That was a
data was
year
even
ago.
old. Have approximately 17.3 million transactions with over 6,500 merchants. So rough math, that's the average consumer has done about 3 transactions.
And they're probably pretty big too. I just want to know what their cut is too.
Yeah, leading to well, that's easy to find out. Just revenue divided by gross merchandising volume. So
I mean, yes, but they also have these tools for merchants and point of sales devices and
do they
stuff.
charge for them?
I
I
don't
don't
know.
know. Yeah. So net of refunds was 10.7 billion. Transaction to the platform since 2012. So just 4 years, 10 billion. 64% of loans are for repeat purchase, and our dollar-based merchant retention rate is above 100% across each cohort that joined our platform since 2016. Our net promoter score of 78 is compared to some of the world's most loved brands and far exceeds those of legacy financial institutions. I buy that.
Yep.
Wells Fargo ain't getting a 78 on net promoter
Mm-mm.
score. Okay. Our revenue was approximately 509 million. So their gross merchandising volume was collectively though, right?
Yeah.
Yeah. So they didn't do 10 billion in GMV. Okay. Representing growth of 9.3 million. Net loss was 112 million. So they did 510 million in revenue,
So roughly 20% negative.
20% respectively. For the 3-month periods, growing 98%. Our loss was 15 million. So 15 million in net loss per quarter. Okay. E-commerce is growing. Yep. That's a mega trend. Buy now, pay later, market share expanding.
Is that 1% right now?
Now, buy now, pay later market share is expected to triple to 3%.
Huh.
So
So
yes,
it's
that would
small.
be triple. That would be triple. And accounts for almost 6% of the e-commerce payment market and is expected to grow to 10% by 2023. Oh, that's in EMEA. So in EMEA, Europe, Middle East, Africa, that's buy now, pay later is already 6% and growing. So it's much newer in North America.
Yep.
Gen Z and millennials lost trust in financial institutions. Yep.
Got it.
25% of millennials do not carry credit cards.
That's fascinating.
Wow. 64% of Americans would consider purchasing or plan for financial products through a technology company's platform instead of a traditional financial service provider. 81% for younger Americans.
These are all people who heard their parents cursing out the banks in 2008.
Right. Or have taken on debt themselves in some way and don't have a good relationship
Tried to
with
call
banks.
customer service and experience what that's like.
121 billion in credit card interest, 11 billion in overdraft fees, and 3 billion in late fees. Yeah, that's a heck of a lot of counter positioning to give up.
And you know what? This just reminds me again. I'm going to go back to Netflix because I think it's such a great example that Blockbuster made all of their money on late fees, and Netflix just said, "We won't do that," and bam.
Slightly more complicated than that, but yes.
Yeah. There's a little bit more to it.
Okay. Limitations of legacy offerings. Complex, predatory, mispriced, impersonal. For merchants, when it comes to acquiring customers, difficulty in engaging customer converting, lack of viable continuing solutions, discounts, abandoned carts. Our solution. Okay. Integrated checkout. Pay over time with 0% APR. Okay, so you choose your payment period. Virtual cards. Universally accepted method of payment on Visa rails.
There you go. Your explanation there.
Yep. So Visa is not threatened by Affirm. So it uses Visa's network. Split payment, fixed payment plan for purchases under $250. So is this with this longer than this one was with interest? This one's not?
No, it's
so it offers lots of payment options is the point. Personalized data-driven product discovery, so you can shop on there, and FDI insured interest-bearing savings account. Okay. Oh, these are just
this is the timeline.
Yeah. Well, that's optionality.
Yeah,
sort
absolutely.
of. Well, are these new revenue things? I mean, the marketplace certainly is. The savings account certainly is. Okay. Simple, delightful, flexible, accurate credit pricing, consumer confidence, seamless checkout. Affirm logo is displayed, seamless user experience, pay with Affirm. So it's kind of like paying with like PayPal, right?
Yep. So it's one of those
Consumers
choices you can
choose
click
how
on.
to pay. Managing payments in the app is simple and transparent. More customers and better conversion.
Totally believe that.
Affirm approves on average 20% more customers than comparable competitor products.
This reminds me so much of Riskified.
Yeah, really. Increased AOV, which is average order value. Average order value.
I believe that. If you don't have to pay it all at once, you're willing to. If someone told me I had to pay $200 for Netflix, I'd be like, eh. But if they're like, how about $15 a month? I'm like, sure, sign me up.
This says Affirm reported 92% and 85% higher AOVs when compared to other payment methods. That's huge.
Yeah.
But I also know I somewhat buy that because I know that like McDonald's, for example, when they issued credit card, when they finally accepted credit cards, their average ticket price shot up. Like
I believe
it went up like 70% or something like that. Increased repeat purchase rate. 22% of Affirm customers cohort made a repeat purchase at the same merchant within 12 months. Compared to what? How many were they doing without Affirm?
Yeah.
Better data, broader target market, ease of integration. Our direct API designed for use by all developers allows for site integration, compliance. We handle the regulatory aspects of loans, irrespective of state or jurisdiction. Okay. Strong network effects, competitive advantage.
I believe this.
We benefit from self-reinforcing network effects, which are advantages that compound with each additional consumer and merchant. As consumers learn about the key benefits, we believe more and more will choose to use our platform, and consumer base will continue to grow. The larger our consumer ecosystem, the more valuable it is
Yep.
to merchants, and the
Yep.
more compelling it is for merchants to offer Affirm.
Especially with that marketplace.
The more, I wonder how big of a deal that is.
I don't know, but it could be.
It could be. Is it? I don't know.
I don't know.
The more merchants integrated into our network, the more reasons consumer have to shop with Affirm.
This is just classic.
Our costs decrease as a percentage of gross merchandising volume as our consumer ecosystem expands. For example, the additional data we have on repeat consumers enables us to make better underlying decisions and therefore generate results in lower provisions for credit loss expenses.
Yep. Buy it.
This is the data argument.
Yep.
Improved direct expense efficiency enables us to create even more compelling offers.
So let's be clear. I just want to break this down here for a second. They're saying that there are basically 3 different types of network effects here. All right. So network effect 1, the more people that use Affirm, the more merchants that use Affirm, the more merchants that use Affirm, the more people would want to. That's number 1.
Mm-hmm.
Number 2, the marketplace. But it's pretty much the same argument, except they're saying that come to the marketplace and you can find products to buy. People are there. Those are kind of the same. But then the third is that the more people we have, the better our AI and our underwriting is. The better our AI and underwriting is, the more merchants will want to use this.
Correct.
Because it's reliable.
On the flip side, let me just point out that the average consumer, according to their data, used 3 transactions over the course of 5 years?
Was it over the course? No, I think it was just over 1 year.
I think that was 2016 to 2021.
We'll have to check on that.
I'm pretty sure that's what it is. So, I view, if you're using Affirm, you're definitely going to use it on, let's say, Christmas shopping.
Right.
Or you're buying something that costs thousands of dollars.
Right.
Or maybe there are some consumers that you're going to use it on a couple $100 purchase. You're not going to use it for grocery store. Right. That kind of paying gas, that kind of thing. Anyway, just something I'm thinking through. The Affirm network strengthens with every transaction. More consumers, stronger ecosystem, more merchants, additional products, grow DMV, deeper data insights, better experiences. So this is what they're arguing as a flywheel. I'll give them some credit. I'm not screaming out like this is CrowdStrike, though.
No, you've got to prove it.
Yeah. This sounds weak to me, is my point. Like CrowdStrike, every new user results in a stronger network. This, I'm not yet convinced.
Would you believe it if they just said the more consumers, the more merchants, the more merchants, the more consumers?
That I would buy. But again, how strong is that?
I think that's there. They might not have called it out.
How strong is that, though? The question is me, the consumer, going to go specifically to some merchant or some website specifically because they offer Affirm?
Well, I mean, in my 20s, probably.
You would? Okay. And
probably.
Again, it depends on
teaching,
depends on the audience, right? Some people that want this, yeah, totally.
Yep.
I'm still trying to think through that. So 47% of our employees were in engineering and technology related roles. Our merchants partners can easily integrate Affirm. Yep. Data advantages that compound over time. Okay. Better outcomes generated by our proprietary risk models. So this is putting them squarely against Riskified.
Here we go.
Here we go.
Delinquency rate.
Our weighted average quarter delinquency rate of approximately 1.1% for the 36-month ending September 30th, 2020.
Now, you know more about this than I do, so you're going to have to tell me. Is that a good number? Is that a bad number? Do you know?
I mean, that sounds like a really good number. That's essentially saying 99% of our transactions are repaid on a weighed basis, which is the correct way to do it.
Yeah, that's absolutely the correct way to do it.
Yeah, that sounds really good.
Okay. I just don't know what a benchmark is. If you're watching and you know the credit card industry, let us know.
Credit cards, I would assume is much higher. That's one reason they charge such sky high interest rates.
Yeah.
One reason is because they typically have to pay for higher losses. Okay, our proprietary risk model generates better outcomes. Cumulative first month delinquency for February 2020 consumers. Consumers ranked by FICO. Consumers ranked by Affirm. So we have a lower delinquency rate.
And
Percent
this is
of
by the
first month
decile
delinquency.
of consumers, from the best ones to the worst ones.
Yeah, so it's better than FICO.
See, I feel like FICO is everybody's punching bag right now.
Portfolio net charge-offs. Charge-offs, this is be transactions that are saying we're never going to collect this.
Yep.
So, well, it's getting better.
See, right there, to me, that's the proof that the AI is learning. Right there. That
Months
chart.
since origination. So they don't count it, they don't start tracking it intensely until it's been 5 months. And then they say, all right, so this skyrockets to 4.5%. And then in 2019, it was 3%. And then in January 2020, it was 1.5%. You also have to throw in the stimulus into this, right?
Yeah, that's fair.
People were getting tons of money from the government. Not in 2019.
No.
2020 they were.
No.
Oh no, wait. This is January
2020.
January 2020. Well,
so this is truly the AI learning to me.
Yes. Okay. Our people come first. This is their culture. It's on us. Push the envelope. Business model. Our business model is predicated on a deep belief that simplicity. Our presence. We have also leveraged partnerships to drive growth. For example, we recently partnered with Shopify on Shop Pay installments to significantly expand the number of merchants and consumers on our platform.
So they got Shopify and Amazon.
Yes.
That's big.
For merchants, we earn a fee when we help them convert a sale and power a payment. Merchant fees depend on the individual arrangement between us and each merchant and vary based on the terms. We generally earn larger merchant fees on 0% APR products. For the last year, 0% APR financing represented 43 and 46% of our total GMV. So having a 0% APR product was about half.
And so the merchant will pay more for that.
Well, it gets the transaction going, and I'm guessing they don't have to offer discounts.
Right.
So that isn't a way of collecting a fee, right?
Mm-hmm.
The structure incentivizes us to help our merchants convert sales and increase AOV through commerce and technology solutions. Okay. From consumers, we earn interest income on the simple interest loans that we purchase from our originating bank
So they purchase it
from our originating bank partners.
Well, I love that level of skin in the game. I know that it introduces risk, but morally, they are equally incentivized. If they do a bad job, they will pay.
Interest rates charged to our consumers vary depending on the transaction risk, creditworthiness, repayment schedule, the amount of the loan, and the individual arrangement with the merchant. Because consumers are never charged deferred or compound interest, late fees, or penalties, we are not incentivized to profit from our consumers' misfortunes. In order to accelerate our ubiquity, we facilitate the issuance of virtual cards directly to consumers through our app, allowing them to shop with merchants that may not be fully integrated with Affirm. Okay, so you can use Affirm even if they don't have your API.
Yep. One thing I'll throw, we said that their delinquency rate was 1.1%. Our friend, Dave Drum, big fan of our channel here, said that per Fred, which is the online database from the government, 1.58%. So they're doing better. However, I would like to see it do a lot better.
Well, that's still 40% lower.
Yes, it is.
Thank you, Dave.
And Anthony says that they've got Target too. So,
they got Target too?
Yep.
Look at this. Are funded and issued by Cross River Bank. Where does that name sound familiar, Brian?
Cross River Bank is the major bank behind Upstart as well, which does something very similar, which is helps facilitate personal loans, mostly through Cross River Bank.
Cross River Bank is like the most forward-thinking technology bank I've ever heard of. They're a major partner of Affirm and Upstart. Okay. When a consumer applies for the loan, our loan is underwritten using our model. Once approved, the consumer selects the preferred payment option. The substantial majority of loans are funded and issued by Cross River Bank, one of our originating partners. We're also able to originate loans directly under our lending, servicing, and broker licensing in Canada and across various states in the U.S. We are able to improve our transaction economics. We act as the servicer of all loans that we originate. So they're responsible for collecting the payment from the consumer, passing it along.
They got to go get it.
Yep. And purchases from our originating bank partners and earn a service fee on loans we sell to our funding sources. We also do not sell the servicing rights on any of the loans, allowing us to control the consumer experience from end to end. To allow for flexible staffing and support overflow, we partner with several sub-services to manage customer care and collections.
Starting
Christmas
6
time.
months and starting 6 months after Christmas.
Yeah. Efficient capital funding. We have successfully attracted a diverse set of funding sources. We had $4.2 billion in funding capacities, and we have funded $10.7 billion in loans. Okay. By linking our pay over time product to a specific consumer purchase and merchant, we can target shorter duration assets. Our repayment options range from 6 weeks to 4 years, with an average duration of 6 months. Creates a multiplier effect on our committed capital, where funding can be recycled quickly, driving our ability to increase volume transactions, right? So $4.2 billion in funding capacity, but that can be $8 billion in funding for a year.
Yep.
Over 6.2 million have trusted us.
I want to see where these numbers are right now.
With sizable representation in the U.S. and Canada. Merchants, the Real, Purple, Kate Spade, Eventbrite, Priceline, Dyson. Yeah, that makes sense. Like a multi-$100 purchase.
Vacations.
Airline tickets. I don't know what StockX is.
I think it's shoes.
Okay. 6,500 merchants, small to big, companies with omni-channel. Our merchants represent a diverse range: sporting goods, outdoor furniture, homewares, travel, accessories, and apparel.
Anything that's over $100, let's say.
The U.S. e-commerce sales were $600 billion, growing double-digit. $7.6 trillion was processed at U.S. merchants in 2019. E-commerce is a small number of that. Consumer acquisition is the lifeblood of all merchants. We believe we can address a portion of the estimated $1 trillion consumer acquisition spending by merchants. New financial products. Our team continues to innovate. We launched a high-yield saving product. We believe our total opportunity includes a range of financial products, all predicated on our principles of honesty, transparency, and trust. Okay, expand to more higher frequency purchases. Yeah. Is expanding into higher frequency purchases? Yes, because right now you are unfrequent purchases. How do you do that? Add more consumers. Drive repeat use.
So let me just say real quick, the thing that's going to ding them a little bit. So if I had the choice between using Affirm or my credit card, I'd use my credit card because basically if you're a super responsible, and by responsible, I just mean someone who pays off their full balance every month, credit card user, I would rather use my credit card because of the benefits that I get from doing that. And I mean, now I'm feeling a little guilty because I know the benefits in part come from all the late fees that these credit card companies are able to collect. So Affirm probably wouldn't be able to offer the same deal. My point just being that it might be a tough sell to increase the volume of those smaller purchases, especially once you get into a certain crowd that pays their bills off every month.
That's that sounds like a tough. Yes, that might seem. Also, keep in mind every time you swipe, you're paying. The merchant is paying transaction fees,
right,
and those are also used to pay off your benefits. So it's not just consumers.
Yep.
It's not just, but there's a lot of subsidy going on where those that pay interest are subsidizing those that don't.
Yep.
To some degree. Deeper in penetration with existing merchants, Affirm represents a small percentage of the average transaction volume. We want that to grow. Increase the number of partnerships. Increase merchant features to help them grow. Expand into new markets. A $200 million revolving credit agreement. PayBright. So they bought
Part of PayBright, which actually funny, Carl C just chimed in a little bit ago that said Canada has PayBright for years, which does the same thing. It sounds like now Affirm owns part of PayBright.
Into a stock purchase agreement for the two issues.
And I agree. Paul basically just said what I was saying
Yeah. Okay.
earlier
So
too.
but they didn't buy it out. They
No.
get to buy some of it.
Yeah, it's like what was going on with PayPal or eBay and Mercado Libre.
Risks. A large percentage of our revenue is concentrated with a single merchant partner. All right, let's Cross River Bank is a big one. Let's do some concentration searching, shall we?
What is the other one?
What?
Would it be Shopify? Because this is before Amazon.
Concentration of ownership. So Class B stock is held by 93.7%. So that's going to answer that question. Okay,
yeah, we know
here we go.
In the game.
Our top merchant partner, Peloton.
Oh.
Represented approximately 28% of our revenue and 30% of our revenue for the 3-month ending 2020. Our top 10 merchants represented 35% of our total. So
the other 9 were super small.
Peloton is the far and away number one thing here.
Here's the thing, though. Do you think that's going to be the case a year from now with Amazon?
I don't know. I can tell you that Peloton makes sense because that's a $1,000, $3,000 bill up front. And I know that Peloton sales have slowed down significantly.
So I think it'll drop.
Oh, that's the goal for any customer concentration.
Yeah, no, but I think it'll drop like a year from now. I think it'll be much smaller.
Okay. Well, I'm curious how you're going to score that. Our business is heavily concentrated in the U.S. credit. We're susceptible to fluctuations and particular risks. Okay. Includes concentration limits, merchant concentration of revenue. 28% of our revenue was from Peloton. 30% of our total revenue is from Jennifer. We have a strong relationship with Peloton. We entered into a renewed merchant agreement with Peloton with an initial 3-year term ending in September 23, which automatically renews. Yeah. So Peloton's a major thing with them right now. They are concentrated in California.
Keegan points out that they also pair with Tonal, and I'm going to guess that they are also an exercise. They're a similar company to Peloton, based on what Keegan shared.
Let's go to their most recent quarterly results.
Let's see these numbers.
To see these numbers. Can you see that okay?
A little. There we go.
Gross merchandising volume grew 106%. Total revenue growth of 71%. So they gave up some of their take rate. Expanded network by nearly doubling active consumers.
You're not done yet. Wait for it.
Active merchants by over 400%. Wow.
Is that just Amazon?
Expects GMV growth of at least 50%, 70% excluding Peloton.
Prior to any benefit from the Amazon partnership.
Wow. So they are really growing fast. Okay. So, more consumers are choosing us. Merchants grew active consumers by 97%. Yep. So GMV in the quarter was 2.5 billion, up 100%, or 178% excluding Peloton. So Peloton is holding them back. Active merchants was nearly 29,000. Yeah, it was 6,000 when we were reading about it. Active consumers grew 97%. Transactions per active consumers grew 8% to 2.3. I wonder when that period is. That over a year?
No, because it says, it's hard to say.
Oh, well, this says
fourth quarter and fiscal year.
I'm going to assume that's per year just because the previous one was
3.
So, yeah. So again, this is an infrequently used thing. Revenues, operating loss was very high, includes 105 million in stock-based compensation.
So the loss isn't actually that bad at all.
Yeah, let's see what so we expect a ton of growth. Advance is partnership. Advance is exclusive partnership with Shopify.
Wow.
$500 million securitization. Okay. A non-exclusive partnership with Amazon. So it's
Okay.
exclusive with Shopify and non-exclusive with Amazon. Split total cost of $50 more into simple monthly payments. Amazon and Affirm are testing with select customers now, and the coming out, Amazon plans to make Affirm more broadly available to its consumers. So it's only some right now, and it's going to be more
Higher.
later. Okay. So GMV for the year, fiscal year, is expected to be up 12, 13 billion. And then their revenue is expected to be roughly, what's that, 9% of that? So I know it's not perfect, but a 9% take rate for this kind of business is darn
That's
good.
enormous.
Darn good. Transaction costs are about half that. So their gross margin
50,
40%ish.
40. Yep.
Revenue less transaction costs. Yeah. Okay. So, well, okay, maybe
That's a more fair.
that would be a 5%ish adjusted operating loss. Shares outstanding going up.
Can we just see what they're spending on on there's so much good data there.
Yeah. So GMV, total revenue is percent of GMV. So that actually declined. Transaction costs as a percentage of gross merchandise volume went up. That's funny. With the scale, you'd think they'd be going down. Revenue less transaction costs. Yeah, I wonder if is this a better number to look at for
I
actual
think so.
revenue? All right. Well, so keep that in mind if you're looking at this company's, for example, price to sales ratio. What are you looking at? Is
Which one?
This is going to be probably what the all the numbers say online, but if you're using this, then you have to double the price
it.
to sales ratio or 60%
Almost.
higher. Operating loss, adjusted operating loss is positive. Adjusted operating loss, non-GAAP. I wonder if there are some one-timey things here.
Yeah.
You don't go from a 30% operating margin to 5%. Okay. Consumers up, transaction per consumer is still very low, right? Partnerships.
Yeah, that's not totally surprising to me.
Yeah. I wonder if any of this was because of their IPO. I wonder if any the fanfare they get from coming public.
Could be. All right.
Balance sheet.
Yeah, let's see what we got.
1.4 billion in cash. Loans held for investment is another 2 billion. Accounts receivable, goodwill. So they bought something for $500 million. But this is a $30 billion company, a $40 billion company?
Yeah.
Okay. All right. Notes issued by securitization trust. So that would be notes and funding debt, total liability. So this here is the big one. Accrued expenses.
What does that
Notes
mean to you?
issued by securitization trust. Notes issued by securitization trusts. Is that debt that they recently issued in order to fund their purchases?
I mean, that would make sense to me.
But that would be funding debt. Well, I'll just say this right now. These numbers are not super straightforward.
No.
There's some complicated things going on with their numbers. Reminds me of Lemonade. Oh, nice color here on revenue. Merchant network revenue, virtual card network revenue. Okay, so merchant network revenue was the big interest income.
Yeah,
is about half of revenue.
Okay, but here's the thing, though. Here's the thing. The merchant network revenue grew almost not at all. It was the virtual card network where all the growth came from.
And the interest income.
Yeah, and the interest income. But just in terms of total network revenue, what's interesting about
this
that?
too.
What is that?
Gain on sales of loans. So they're making loans. The loans are becoming more valuable. I wonder if that's because of interest rates.
Could be. But what's interesting to me is that the consumers are driving this more than the merchant network, the growth from the network revenue. So just to be clear, the virtual card network revenue means that I use my Affirm virtual card on my phone and I go to a store that isn't part of Affirm's network, but I can still buy something with it because that's how the card works on Visa's rails.
Right. Yes. So that's just something to keep in mind there. Okay, expenses, loss on loan purchase commitments. That went down. That's
That's
good.
great.
Provision for credit losses. So last year it was negative. This year it's positive, but that's an expense. So that's a big that's a $50 million delta.
But that's over the 3-month period. If you look over the 6-month period, it's reversed, which makes me think that you need to remember what was happening between April
Yeah.
1st and
Well,
June
that's just going to be
30th of last
something
year
wonky with these particular financial
because of
numbers.
COVID.
Funding costs went up, processing and servicing fee, technology. Okay, G&A
Holy cow, look at
went up
sales and
100
marketing.
million, as did sales and marketing. But how much of that is stock-based comp?
I don't know, but that's a big jump.
You don't go up 12x without that being. That's all. That huge guy. Much of that is going to be stock-based comp. Did they call that out? Okay, yeah, 110 million.
Yeah, but sales and
G&A.
marketing, it's just 6. Oh, I guess that's half. No,
No, sales and marketing. Oh
no,
my
sales and
gosh!
marketing truly went through the roof.
Truly went up 10x.
We probably have at least 6 Affirm salespeople watching this video now based on those numbers.
G&A. Yeah, that's all stock-based compensation. So the management team got a huge payout.
Whew, that is crazy. They
Yeah.
10x their sales force.
Yes. Well,
That's how they 4x,
that's how they
5x
grew their
their
merchant base by
Yep.
4x or whatever. Okay, cash flow statement. By the way, this video is getting long, and we haven't even gotten to stuff, but this is a complicated company. Yeah. Net loss. So they had a net loss. Proceeds from the sale of loans held. Purchase of loans held. All right, so these two largely neutralize each other. So the big delta there has got to be stock-based compensation is 110. Yep. So
You've got the full year to the right too.
They were free cash flow negative. So they're still free cash flow negative, even with their big stock-based compensation.
By quite a bit too.
Okay. There's a lot going on here.
Yeah.
Okay, so we know about their Amazon partnership. Let's go to back to their 424 before and do some ownership. Dilution. Principal stockholders. I expect to see Max Levchin with a whole bunch.
Yeah.
Max Levchin, 700,000 Class A, 26 million Class B.
Didn't sell anything.
26 million. He owns 20% of the voting power, of the total voting power.
Shopify owns 8% of it.
Shopify owns 8%. Lightspeed Venture Funds. Lightspeed is another payments company that we have yet to research. Khosla Ventures, that dude's awesome. Vinod Khosla. So insiders are what? Where's the total for insiders?
Well, they should tell us. Oh, there you go, 31%. So
31%. I mean,
63 million shares.
Yeah. So Max Levchin owns 27 million times $150 per share price. That's a few $1 billion.
Yeah.
Skin in the game.
Yep. Enough to, I know where it is relative to what I'm looking for.
Glassdoor, Affirm. Okay. Mission. Deliver honest financial products that improve lives. It's nailing the mission statement one. Returnly. That the payment network empowers completed acquisition of Returnly, a leading online return experience and post-payment company. So that's the 500 million.
That could be the 5.
Yeah. 91% CEO approval rating, 4.4 stars, 86% recommend a company to a friend.
Wow, those are high numbers.
Yeah, pretty good for senior management too. That's usually the lowest one. All right, one extra bit of research here. I found this thread by Francis Analyst, Investee Analyst. I haven't read through it completely yet, but he did a tweet storm on Affirm. Might be worth reading into this. Okay, so let's begin with the first principles. It's buy now, pay later. Great overview by my friend. Yep, we know how buy now works. Frictionless point of sales, relationship with merchants, history. Okay. Distribution models, directed merchants across 3 continents. Yep. Okay, so look at this. Here's the buy now, pay later landscape.
Yeah, I'd say it's crowded.
Yeah. In the US, Affirm, Sezzle, Split It, Change After, PayPal, Bread, Jifty, MasterCard also is getting into this market.
Yep.
Direct merchant suppliers, Afterpay, Sezzle, multi-lender networks, MasterCard puts Vizzy, Charge After, credit card issuers, white label providers. So, yeah, it's a feature, but you got to have something that protects you. Okay, so they're a first mover advantage in the US. They have a head start in 10 years of core competency. They have a big amounts of data. They have an economist working there.
No, the economics. The buy
Okay.
now, pay later economics is working for them.
Okay. Is the new MDR fees for Affirm. You really need a ubiquitous parallel network. This is a core part of the moat. As a parallel network, there is much potential for many transactions and payments to happen on buy now, pay later rails due to SKU level that buy now, pay later receives. Imagine what these three parties can create in the funnel that bypasses the issuing bank, card network, and merchant acquirer. It's just the consumer merchant, and this is exciting, a new partnership, the product manufacturer. Huh. So they're bypassing the issuing bank, the card network, and the merchant acquirer. So I guess it is a threat to those banks. This could be the reason why recently Walmart and Target recently updated their layaway services in order for them to use and adopt Affirm solution. So Walmart, no will sales will be offering layaway. Walmart will now offer consumers a monthly buy now, pay later finance option called Affirm, calling Affirm an alternative to layaway. Okay. Alternative to layaway. So they're disrupting layaway too. Great. Efficient underwriting. We saw this. Delinquencies. Best conversion checkout rates. Shop Pay launched Affirm, allows Shop Pay 50% increased AOV and 28% less cart abandonment, 30% improvements in speed. Trusted name. Yeah, they're up there. This is how good of a score was 78
That's a
is.
big deal.
They're ahead of Disney. Peloton. Every merchant would rather pick a buy now, pay later provider that allows them to reach more customers, a strong network effect.
That makes sense. I buy that.
Bargaining power. Partner of choice. Yeah. Okay.
All
the
right.
market's huge. All right, we'll throw this in the show notes or put it out there. But thank you for that great analysis. So they have a bigger moat than I would give them credit for. Is the point? They're more than just buy now, pay later.
Yes.
Okay. AFRM. Okay. Time to fill in some quality scores. Do they have recurring revenue? Yes. Are they profitable? Not even close. Are they free cash flow positive? Nope. No. Have they beaten the market? I think so.
Yeah.
Okay.
50% year to date.
AFRM, today's date is 10/14/2021. Financial resilience. Their balance sheet was tons of cash, but
it was hard to tell.
Don't fully. I don't think it's like bulletproof.
Yeah.
I'll give them a 3 out of there. Their gross margin depends on how you calculate it. Yeah. Which number are we using? I'll give them credit for the top line number and say that it's 50%. I'll give them a 1 there. Returns on capital are negative. Free cash flow is negative. Earnings per share is negative. Moat. Okay. Here's going to be the tough one. Do they have the network effect or a product ecosystem? I'll give them some credit for that. I'll give them 5 points for that. Based on the more merchants, the more consumers, and they're clearly pouring huge capital resources into both networks to grow them. Are there switching costs? Switching costs for who? Switching costs for the merchants, for sure.
You think so?
Yeah, if you're using it to get data and analytics.
Sure. We don't know how many are doing that though.
I'll give them a 5 there. Durable cost advantage. No. Intangibles. Is the brand name strong?
I mean, those NPS scores.
Yes. I'll give them a 3 on that. I don't want to give this company like full credit for moat, but I think that's pretty good. And their moat's getting wider faster.
Mm-hmm.
18 out of 20 is
What about counter positioning?
is pretty good. Counter positioning? No, because of all the competitors they have.
Yep, that makes sense.
If it was just them versus the other
Yeah.
ones, then yes, but not for now. Optionality. Do they have the ability to roll out new products and new services? Yes, and they're doing so. I'll give them a 5 there. The fintech market is huge. Organic revenue growth. Boy, are they growing fast. 4 out of 4. Are they the top dog and first mover in an important emerging industry? So I think they're the top dog and
I
first
think
mover
that they
in
are
the
too.
US.
Yep.
They're not globally, but they are in the US. So I'll give them full credit there. Do they have operating leverage ahead of them? Yes. Customers. Are customers expensive to acquire? Yeah.
Yeah.
Right. They're spending
10x.
Yeah. They're spending on sales and marketing is sky high. I'm going to give them a 1 there. Once a consumer gets on board, is the consumer dependent? Is that recession-proof spending? Yeah, you could argue that even in a recession, the demand for this would go up.
Yeah.
People would want to spread out there.
It depends on how they measure the risk of each consumer, though, too, because in a recession, the risk of consumers being able to pay back also goes up.
Correct.
Which means
And they are
might
taking some risk
approve-
there.
Right. They might approve fewer because they are on the hook for it.
I'll give them a 4 out of 5 there. Is revenue recurring? Yep. I'll give you full credit for that, even though it's not like I'll give them full credit for that. I'll be generous on that one. Pricing power. I think is there room for gross margin expansion? Maybe. I'll give them a 4. Maybe.
In their side offerings.
Soul in the game. Love your founder. Love the inside ownership. Love the Glassdoor ratings. Love the mission statement. Checks all those boxes for me.
Yeah.
How has the stock done since it came public? I'm pretty well. It IPO'd at 49. The actual price that you could get the stock. Yeah, so I think it's up 50%.
Yeah.
The market's probably up. So I'll give them a 2 out of 4 there. Are they buying back stock, paying a dividend, or repaying debt? No, we don't want them to. And how are they doing versus expectations? Let's check Yahoo Finance to see what they say. I have a feeling they're exceeding them. Miss, beat. Are these accurate? I don't know, but I'm going to give them a 0 on that front. That might not be wrong because I've been burned before by going to Yahoo and then Yahoo was wrong.
One quick thing, just as you were talking about recession proof, Keegan and Dave both chimed in saying in a recession, people are less likely to buy expensive products. And Dave pointed out that in a recession, unsecured lending gets hammered.
Thank you. Yeah, because there is some credit risk here.
Yeah.
And is the recession we just went through a normal recession?
No.
So, okay. So I might have been overly generous on that. Accounting irregularities, no. Customer concentration. I'll knock off 3 points for the Peloton. That could come down in time.
Do you worry about Cross River?
We didn't see the exact amount of Cross River.
Well, it said the substantial majority.
Yeah. I'm fine with knocking a couple points off.
Okay.
Outside forces, interest rates.
Recession.
No. Strong economy. No. But kind of.
It's tough.
I'll pass that on up, but that might be generous. Big market loser, binary event, extreme dilution. This company loves stock-based compensation. I'm going to knock off at least 2 points for that, right? Their share count was expected to grow 4%. Yeah. Growth by acquisition, very small by comparison. Complicated financials.
Yeah, it's close.
Yeah, they aren't easy. I'll again be generous. Antitrust concerns, headquarter risk, currency risk, -5. Either way, it's a 63 for me, which is in my essentially too hard pile right now.
Yeah, I and it's too hard, and you were even being generous.
These numbers could improve
financials.
These numbers could improve dramatically once it grows up, and yeah. So I'm after high growth, low risk. I view this as high growth, high risk, or medium risk for right now.
Yeah. Okay.
So for me, it's in the anti-portfolio for now.
So mission statement, love it. This is a great mission statement. All right. So for the moat, I give them 2 points. I give them full credit for the network effect.
Ooh. Okay.
Here's the thing. There is that there's the customer merchant network effect, but I think that AI network effect, when you see those rates continually go down before any stimulus checks went out, I believe that that's there. So I give them full credit for that. I give them 1 point for brand, and I will give them a half of a point for switching costs. I'm not sure. That is more just like, it's almost like a note to me to be like, if I come back to this, I need to research that more.
Okay.
Optionality, I'll give them 2 points. I could see this venturing into 3, but that's where I am right now. Okay, so for this, I give them a negative half point because I don't quite understand how much of that securitized note is debt, and they're losing a lot of money in free cash flow. Concentration, I'm going to take a 1.5 off, both for the combination of Peloton and Cross River. I understand making a big deal about Cross River. Clearly, in Upstart's case, was not a thing. It might not be a thing here either, but that is what it is.
You're
I'm
making the
not
best
worried.
judgment call with the information you have.
Yeah, I'm not worried about Shopify though, because Shopify owns 8% of the company. And then for each of these, I give them a full point. So you do that, and it comes out to an
8.5.
8.5 for me, which is right in the middle.
Right in the middle. Yeah. So for you, this is
definitely investable. I'm not going to run out and buy it because, like you, this is in the. It's not in the too hard forever pile, but it's definitely in the too hard after an hour and 12 minutes pile.
yeah. I almost want a third category for our portfolios. Like there's the ones that are a definite yes, there's the ones that are a definite no,
Yeah.
and there's the ones that are like maybe it just doesn't meet my. And this is in that middle group for me. If you own this stock, I totally understand why. The growth is definitely there. It could be a big winner. I just put it in my why bother when there are other high quality stocks
Exactly.
that are just ahead of it.
The thing
So
about investing that everybody needs to understand is there are no called strikes for missing an opportunity because there's so many opportunities out there. You don't. Our friend Tom Gardner, CEO of the Motley Fool, said on Twitter recently, you need 5 big investments in your entire life that you just don't sell, and that's more than enough to reach your financial goals. You don't need to go out and try and get 25 of them. So like you said, if there's something else that makes sense, that's easier to understand, then yeah.
right. So I'm going to put this I put this in the anti-fragile portfolio. This is Brian's thumbs up portfolio. I'm going to put this in my anti-portfolio, which is the best portfolio that we have, by the way.
The ones where Brian gives the thumbs down.
So far, I'm really good at saying pass on this awesome stocks. But yeah, again, I'm not anti this company in any way.
Right.
I just think, is it going to enter my portfolio now? No, it's just, it's slightly too complicated and it's slightly too early. But could this thing be the next PayPal? Sure.
Yeah.
Like it definitely could.
And while Brian is doing this, again, thank you to StockCard for sponsoring this video. But we want to point out that if you go to StockCard, use the code ANTIFRAGILE, you can get off and becoming a member here. But also, you can build your own portfolios, and you don't have to use real money to do this. And what could be really fun is to see how you do versus, well, in this case, Brian's thumbs down portfolio. It seems like that's a tough one to beat. We got to keep an eye on it.
I'm really good at passing on stocks that do awesome as a group.
Head on over to Twitter at the end of every month. Let us know how you're doing. We're in talks to try and get some type of prize. And the one caveat I'll throw in there is that don't backdate your picks. Any picks that we backdated were simply because we had a video to match with it. So you can't go back and say, I bought Tesla in 2013. Even if you did, there's no way to hold ourselves accountable for that.
Yeah. Thanks, as always, for the great people that watch this and the comments. Some people know most better than we do. So Nicholas saying it deserves 1% to 2% of your portfolio. Founder of Max Levchin of the PayPal Mafia is phenomenal. Say no more. No disagreements. No disagreements there. Dave Drum just says buy the rails, Visa and MasterCard. Those are 2 that I own for sure. It's lower risk and low risk ways to do it. But yeah, their partnerships with Amazon, Shopify, Target, Walmart are really impressive. Dave Drum with that great comment about the number of partnerships this company is signing up is impressive.
Yes.
Like it's very impressive. Um,
And Paul brings up a good point in that last one. Like it's hard to see if I'm someone that pays off my balance every month, it's hard to see that person using Affirm. But there might be so many people out there that don't do that. It doesn't matter.
yeah. Shane says go check out their investor forum on their investor relations page. The Amazon deal is for pilot testing. It's not implemented. Yeah, that's an important caveat. Apple has partnered with PayBright.
And again,
Great.
they didn't buy PayBright. They own a part of PayBright.
Yeah. Uh, yes. No. So great questions. Great questions as well as some other. Why not buy Amazon instead, Nicholas?
I
We
own it.
we like Amazon. Yeah. Thank you all so much for the wonderful comments, and thank you to our channel members that for suggesting Affirm. I certainly learned a lot,
Oh yeah.
and I would say that the overall my takeaway is the moat is higher than I thought.
Hmm.
There is a ton of competition in the space, but the company definitely has a great founder-led management team. What other new products can they roll out next? And they're accelerating their expending on sales and marketing in order to drive merchant acquisition. That strategy is working. Like
Yep.
we've seen, if they can keep this hyper growth up, again, I could easily see this being a winning stock.
And for me, the bigger thing is I need to understand all the financial risks involved with this before I would make a decision.
Yeah. Yeah. Also, it's we're not big on valuation. It's a $40 billion company trading at, what was the revenue? 870 million. And again, depending on which revenue
Yeah.
you're using.
It might be 40 times sales. It might be
Yeah.
like 70 times sales.
So the way that I would look at this company is, do I think 10x returns are possible? Is this going to be a $400 billion company someday?
Could be.
Maybe. Maybe. What are the odds of that happening? I don't know, but I understand why people like it.
Yeah, and position sizing plays a huge key in something like that
For
because
sure.
if it's 1% of your portfolio or less, if it goes bust, you can handle that, you know.
Right.
But if it goes 10x, great.
Great. All right. Well, we hope that you enjoyed this. We hope that you learned something. We certainly did. If you didn't want to watch the full thing, we will be doing a 5-minute summary video in the next week or two. So thank you so much for watching. My name is Brian Feroldi, and my mission is to spread financial wellness.
My name is Brian Stoffel. My mission is to minimize finances as an obstacle to wholehearted living.
Brian's out.